Let's start with some major financial news. China's regulators have stepped up efforts to tackle a growing wave of defaults in the bond market. This story truly deserves being in the top spot. With a valuation of just over $14 trillion, China boasts the world's second largest bond market after the US. Moreover, the total value of China's outstanding corporate bonds is also ranked number 2 in the world at $2.8 trillion. So, as defaults grow, the potential problems for the whole economy are massive. This poses a huge conundrum for regulators. How do they respond to bondholders' demands to protect their investments, but without bailing out bad businesses and bad investments, and while still being fair to everyone?
So what's led up to this situation?
Well, given the jaw-dropping scale of debts, the history of defaults in China's bond market is actually surprisingly short. China's first corporate bond default occurred only in 2014. The default came as a real shocker, defying the long-standing expectation that the government would always bail out such troubled entities. Since then, defaults of domestically traded bonds have pretty much exploded, exceeding $18 billion. And as defaults increase with the slowing economy, investors are complaining about the lack of protection. You see, once a bond defaults, most bondholders are in a very weak position to recoup any of their debt compared to other types of creditors. On top of this, the process for handling bond defaults is notoriously slow in China. Indeed, as of the end of August, only 53 of the more than 300 defaulted bonds had been successfully sorted. This has triggered an avalanche of bond default-related disputes pouring into Chinese courts, with more than 400 lawsuits filed. Yet, without unified legal guidance, different courts have been handling cases very differently. And this is why I'm talking about this today. The regulators have said enough is enough.
So what action are regulators now taking?
Well, on December 24th, senior officials from the central bank, the securities regulatory body, the Supreme Court, and other departments put their heads together to hash out some solutions. Then, on Friday, 4 draft policy documents were delivered on key issues in the bond market. These included setting out a default disposal procedure, the responsibilities of trustees, and regulations on bondholders' meetings.
And what's the main takeaway from all these policies?
Well, for one, the policies set up a regulatory framework for corporate bond disposal. In essence, these moves aim to regulate bond restructurings and swaps, as well as emphasize the role of bondholders' meetings in managing the contractual relationship between investors and issuers. What's also pretty striking is that the measures focus on solutions outside the courts, in hopes of recovering investors' losses as much as possible. The hope is that dwindling companies can be brought back to life with transparent, market-based measures. But what I should stress is that these steps are just a starting point. Implementing a policy is a whole other ballgame. Now, the entire story is actually covered in a lot more depth on our website, and as you can imagine, there are a lot of intricate details that we just can't go into on the podcast.
Which reminds me, Caixin is currently offering a fantastic 20% discount for our English and Chinese combo pack.
Whoa!
This special New Year offer includes unlimited digital access to both the English and Chinese versions of Caixin English website and Caixin app. But hurry, since the special price is only available till January 2nd.
Doug, the marketing